Hello, everyone, and welcome to our financial webcast presented by Legend. Today's webcast is titled Understanding Current Market Volatility with a Q&A with Jim Holtzman. My name is Dan, the moderator for the webcast. Today's webcast presenter is Jim Holtzman, CFP, CEO, President, and Wealth Advisor of Legend Financial Advisors. Please hold as I turn the broadcast over to Jim.
Okay, thank you everybody for joining us today. So the markets have been quite volatile over the last month and a half and even for the entire year. So we're going to talk about some of the reasons for that. I'll show you some information that will outline how volatile it has been compared to recent times. And then we'll talk about some areas that can help with your portfolio in terms of reducing some of the volatility that may be occurring there. So the first thing is it's a chart of the S&P 500 on May 4th of this year. So this runs for the entire course of the market day, so basically 9:30 up until 4 o'clock. So the way the market started out that day, it did start out on a positive note. Then you could see it dropped off, and then it started to perform really well, around 2:30 in the afternoon, and then went up into a major upswing. And some of this was tied to a Federal Reserve meeting, and whenever the minutes were being released from that meeting, it had a very positive reaction for the markets. The reason why I pull this up is to show you just how volatile the markets can be during the day. In this case, it was somewhat calm, if you will, until you reach that 2:30 point, then everything took off. So if you just took your eyes off the market for a couple of hours, towards the end of the day, you can see how volatile things became. Now, on the flip side, this is the following day on May 5th of 2022. And in this case, we're looking at a lot of downside volatility. And most of the downside, or a good portion of that, occurred in the first couple of hours of the market opening. And you can see that reflected here. And the times are at the very bottom, so this was 11:30 in the morning. Then you can see the markets rallied, then it dropped off again. Rally, drop, and so on and so forth. And this is pretty normal in terms of within a market day. But then as you get towards the end of the day, around 3 o'clock or so, you can see the markets go in for another downturn to hit its lowest point of the day. Then there is some recovery from that point through the rest of the day. But again, the main point on this is to show you just how volatile and choppy the markets have been. So you go from May 4th with a big rally at the end of the day, and there was some thought that might carry through because of the Federal Reserve meeting. That just wasn't the case. Markets fell right back down in those first couple of hours. At least the majority of those losses for the day were incurred. So this is another way to look at the S&P for 2022. This highlights some key points during the year and what happened with the markets at those times. We started out the year, S&P hit an all-time high. I believe that was January 3rd or January 4th. And then you can see things started falling apart. This is before the war in Ukraine started out. And the main reason for that volatility is highlighted right here, with the Federal Reserve signaling that they might increase interest rates earlier in order to stem the flow of inflation. And then you can see how the markets basically fell off from that point through about towards the end of the month. And then they did rally, and then we get down to another low point, and that is when the war started in Ukraine, basically February 23rd. You can see we hit, at least for the year, a new low. Then we did have some rallies, but then we had some of the impact of the war in Ukraine, the most obvious one being the price of U.S. crude, reaching $120 per barrel. And that caused the markets to hit a new low for the year. Then we had a little bit of a rally, then another drop back down to where it almost was at the lowest point. And then we get into the period where the Fed actually raises interest rates. And that was the first time since 2018, around the fourth quarter of 2018. And you can see the markets actually did rally from that point. The markets were pretty much pricing in the increase by this point, so the sheer act of raising interest rates didn't spook the market. It didn't cause any major concerns. This was pretty much what the Federal Reserve had signaled. And so there was no real surprises to the markets at that point. So we did have a pretty nice rally, and that got us through towards the end of March and going into April. And then you can see this most recent downturn has been pretty steep. And there have been a couple of small rallies along the way, not much though. And so some of the highlighted points on this one is that real meaning after inflation, 10-year Treasury yields turned positive for the first time in 2 years. So meaning that you have the interest rate on the 10-year Treasury was increasing, and while inflation was increasing, at that point it wasn't enough to keep the real return negative. It actually went positive. Then you can see the markets fell off from that. And then most recently, at least one of the main highlights is when the Federal Reserve raised interest rates by 50 basis points or 0.5%. And that caused the markets to go through another downturn, relatively short rally, then falling back down to this point in May. So it's been pretty choppy. There are a few things you can point to as reasons for that. And for the most part, not a real surprise that has taken place. And then we'll move on to the next slide to take a look at volatility in a little bit of a different way. So this one shows the VIX, and the VIX is a volatility index, basically reflecting volatility in the S&P 500 for this particular case. And that is reflected by this orange line. And then the gray bars that you see are indicative of bear markets. So if you look at that one for a minute, this goes back to the mid-90s, and this reflects the 2001 bear market. And then here is the financial crisis, so 2008, early 2009. And then over here, a really skinny bar, this is reflective of the COVID bear market, which was extremely short-lived. And not only were the markets rebounding quickly, the economy did bounce back pretty quickly to get out of recession, but it was a recession. So the one thing that's very interesting about this is that the VIX does a pretty good job in terms of signaling when a bear market is occurring. So generally speaking, when volatility increases, it's not good for the equity markets. That kind of makes sense. So you have volatility rising, the markets don't like volatility generally speaking, and the markets tend to fall off at those points. And then of course the reversal would be true. When the VIX or volatility is trending downward, then you tend to have more calm and better market performance at that point. So when you go back to the 2001 period, there was a spike back here, but this was still in the late 90s. And then you can see it did get choppier at a more higher level, certainly than it had been in the mid 90s. And I'm sure as everybody recalls, this is how the tech buildup occurred. And it was very low volatility over that period of time. And then after we got out of the 2001 recession, then you can see volatility really dropped off again. And the markets did really well from that period of 03 to 07. And then we head into 2008, and all of a sudden we have a huge spike. And basically at that point, at that time, it was the highest point in history for the VIX. And if we just kind of move over to the left, you can see the VIX was topping a little bit over 80 at that point in time. And we all know what happened to the markets at that point. From high to low, the S&P 500 was down 56%. Then you can see volatility did drop off as we head in towards 2010. There are still a few spikes that occurred. We had the European credit crisis that occurred. And for the most part, though, the volatility was pretty short-lived that did occur. And volatility, for the most part, was trending downward over this entire period up to the COVID crisis that started in February, at least from a market perspective. And at this point in 2019, this was one of the lowest volatile calendar years we had ever had. And you can kind of see that visually as you move across the screen. There were some periods in the mid-2000s that were a little bit lower, but 2019 was a really low year in terms of volatility, and a lot of different asset classes did very well. But then we had the spike for COVID, and this is a really significant spike and reached all-time highs for the VIX, as you can see. But then the drop-off was equally as sharp. And then for that period, kind of through the rest of 2022, we did have 2020, we had a couple of other spikes that occurred. Then things did somewhat slow down towards around the beginning of 2021. But you can see volatility has risen again as we approach 2022, and you can see that it is higher than some of these really low volatile periods we've had. So that also gives some explanation, at least confirmation about why the markets have been so volatile. Another way to look at this for stock market volatility is that for 2022, and this chart's a couple of weeks old towards the beginning of May, but what the point on this is that 1 in every 12 trading days at that point has closed with a change of 2.5% or more. Now, putting this in a bar graph form, you can see already for 2022, basically only being a little over 4 months into the year at this point, it's somewhat high compared to entire years as you sort of move across the screen. Now, 2020, as you probably can imagine, you can see the volatility moves was much higher for the year, and basically the second highest in terms of 2.5% or more moves in the calendar year. And then you have to go back to 2008, where we had the highest number of 2.5% moves in history. Even going back to 2000 to 2002, you clearly see the jump up that did occur. But as far as the day-to-day volatility, it wasn't quite as substantial as what we've seen in 2020 and in 2008. So just another way to look at volatility. This reflects the S&P 500 for the entire 2022 year, and you can see the daily percentage move is on this side, and then you can see the dates along the bottom. So you can see at some of those points where the Federal Reserve hinting at interest rates going up sooner. That's that volatility measure we had looked at before in a different manner. Then we have the beginning of the war. You can see another spike there. And then more recently, some of the increased volatility we've seen is reflected by some of these peaks too. And some of those days included 4% moves in the market. And then we have a 5%er back in mid-January of this year. So just a different way to look at it. And it just highlights the increased volatility we have been seeing. So as a reminder, some of this you could point to as being more normal in terms of volatility, because we've been in such a period of low volatility. I think it's got most investors kind of into a lull, thinking this is the way it is. But historically, that is not the case. So this shows you from 1900 through the end of 2021. A type of decline is in this column. So the first one is called a dip, and that is a 5 to 10% drop. So that's a high point to a low point. It could be in any part of the year, and that's what it is defined as. So historically, there have been 391 of these in the course of this 121-year period. The average is 3 times a year, and the average, when it says average length, that means recovery time from it. The average has been about 46 days. So when you look at a year like 2019, we didn't hit, I don't think we hit one day where the market, or where we had a high to low, of even 5%, just to put in perspective how low volatility did get. Now, a correction, which everybody's pretty familiar with, at least the term, it's defined as a 10 to 15% high to low. There have been 127 of these, and then about once a year those occur, and then you have the average recovery of 115 days. Now we get into the severe correction, 15 to 20%. That occurs once every 2 years. Recovery period is 216 days. Now you get into bear market territory. So from a high to low, that is where the NASDAQ is at this point. The S&P 500 did drop into a bear market in terms of a high to low about a week ago. And then the number of declines for that has been 17 and occurring once every 6.25 years. The recovery period is almost a year. Then you get into a severe bear market of 30% loss or more, 16 over history, once every 8.25 years, and the recovery is almost 23 months or 2 years. So, excuse me, a couple of things you can notate is that as the declines get to be more, those recovery periods increase. So that's the importance of trying to mitigate some of the downside volatility. And there are ways to do it, which we'll cover towards the end of the webcast. So the other problem that has come up this year and even last year, and this is not surprising, but I think it's still caught a lot of investors off guard, is not only has the equity market's been very volatile to the downside, so has the bond market. So this is a chart of the 20-year U.S. Treasury bond, and this was through the beginning of May, and it's meant to just illustrate how rough the bond market has been. So this is reflective of 20-year Treasury bonds. So Treasury bonds are going to be backed by the U.S. government. However, what they don't back is a lack of volatility, and you can see that because at this point, in those first a little over 4 months of the year, the 20-year Treasury bond's down 22.84%. So if the year ended at this point, this would have been the worst loss in history for the 20-year Treasury bond. So for investors that kind of have a standard 60% equity, 40% portfolio, 60% maybe is in the S&P 500, maybe some NASDAQ, 40% often will go into what's called the U.S. Barclays Aggregate Bond Index, which consists of treasuries and some mortgage-backed securities. But if that's the case, then you have both parts of your portfolio are down, where historically, for the most part, treasury bonds and even the more traditional bond market usually adds some cushion to when the equity markets fall. The problem has been in this cycle is that equity markets have been expensive, and then the bond market became more expensive, and that happens whenever interest rates reach a really low point, because there's an inverse relationship between interest rates and bonds. When interest rates go up, bond prices come down, and vice versa. When interest rates go down, bond prices come up. Well, since we were at historic lows in interest rates whenever we headed into this part of the market, the bond market was historically overvalued, and some would argue that some parts of the equity markets were historically overvalued, but both were certainly expensive, so you had to invest differently to avoid some of this volatility that we have been seeing so far year to date. So this shows you the price impact of a 1% rise in interest rates. And so the way this reads is that at the very top part are for U.S. Treasuries. That's what UST stands for. TIPS are Treasury Inflation Protected Securities. So I'll go over one in detail and explaining what the colors reflect. So we'll look at a 30-year U.S. Treasury bond. So what this means is that if interest rates go up 1%, the total price of a 30-year Treasury bond would actually drop 19.8%. That's the gray bar. And then the blue bar is a little bit less because it reflects the coupon payment that you would still be receiving. So the total return would be minus 17.4%. And then if you look at the other extreme, a 2-year Treasury, you have a pretty small difference. You have 1.9% loss on the price return. Then when you factor in the coupon, the total return loss is minus 1.7%. So if you look at this, one thing you might observe is that as you go lower on the maturity range of these Treasury securities, the losses go down quite a bit. So that is one way to mitigate the impact of interest rates going up in a bond portfolio. Now, the only problem with it is, while it really does that, as you can see by these movements, is that interest rates have been so low. Yes, you can get your volatility down by using a 2-year Treasury, but your coupon rate has been pretty much next to nothing. But your 30-year Treasury has had a better interest rate, but not by much. And so you end up having the volatility associated with it. And if you bought a U.S. Treasury at 30 years, you're locking in a really low rate for 30 years, especially in a period where inflation has started to pick up. The only other thing I will show you here is these are different kinds of bonds, non-U.S. Treasury. It reads the same way. IG stands for investment grade corporate bonds. U.S. aggregate, that's basically the index I was mentioning before with mortgage-backed securities and U.S. Treasuries. Convertibles, these are bonds that can convert into equity. This actually shows the best return, but it has both equity and bond risk in it. This is high yield municipals. MBS stands for mortgage-backed securities. ABS stands for asset-backed securities. And then at the very bottom is a category called floating rate. And you can see here is that the price difference whenever there's a 1% rise in rates is basically break even, a very, very slight loss. But then when it factors in the coupon payment, it actually boosts it into positive territory. So this has been one way we've been able to mitigate interest rate risk in our client portfolios. Last year, the Treasury bond market was down anywhere from 3 to 7%, depending on how long of a maturity you're using. The floating rate funds that we used in our client portfolios were up anywhere from 4 to 7% last year. And the reason why is that the term floating is really important. And what that means is the underlying bonds have an interest rate that will float or adjust upwards as interest rates go up. So that mitigates, almost eliminates that interest rate risk that I was describing before. The only trade-off, though, you have to recognize is that you are taking on more credit risk with a floating rate bond versus a U.S. Treasury, but we think that's the better risk to take at this point in the market cycle. Then as rates go up, we'll be doing some shifting away from this part of the market down to some of these other areas, including maybe some treasuries. All right, so now we're going to look at why the market has been so volatile. So there's a number of points you could certainly make. Certainly the invasion of Ukraine has been a big one, as we saw in the volatility charts. Another area that's caused volatility has been China's COVID crackdown. So this is impacting the supply chains very significantly right now, and they are basically going with a zero COVID policy. And I know the city of Shanghai was shut down completely for a period of time. I believe it has opened back up, but I think that's on a slow and measured basis. Interest rates, generally speaking, when rates are going up, it is going to increase volatility. So interest rate increases on the short-term side have been happening. Those are the meetings that the Federal Reserve has whenever they talk about interest rates. So whenever they meet, when you hear about rates going up, that's really indicative of short-term rates. Then you have interest rate increases for the long term. The Federal Reserve influences long-term interest rates, but the market really drives that. And so long-term rates, and you can think mortgage rates for this purpose, have been rising quite a bit over the last few months. And that's another way for the market indicating that they believe inflation is going up. So that certainly causes volatility in the equity markets. And as I mentioned before, related to China, the supply chain issues, just in general, as a result of COVID and just some of the supply chain issues that came out of that, certainly has caused some volatility in the markets. So the impact of rising interest rates on the economy, some of this will be obvious, increase in consumer spending, decrease in corporate profits, higher U.S. deficits because interest rate expense will be going up, and probably less tax revenues ultimately. The increase in interest rates for bank accounts, so that's certainly a positive thing, but you also will have slower home sales as mortgage rates go up. So these are just some of the areas you have to be careful on when you're looking at investments, perhaps. You want to understand a company and how their profits are impacted by rising interest rates. If they have a lot of debt on their balance sheet, that could be a red flag that you want to be careful about that. So some of this is obvious, but it all adds up in terms of how it impacts the overall global economy. So this is interesting. This is a U.S. real, again, real meaning after inflation, GDP, gross domestic product, which is basically our economy, and a forecast. So this was done by Morningstar. So their number is in blue. The consensus is in red, and the Federal Reserve projection is in green. So for 2022, you can see the good news is that everything's positive. Morningstar has the highest number at 3.5%. The consensus is 3.2, and the Federal Reserve number is 2.8. So as far as the definition of a recession, this isn't the technical definition, but for the most part, it looks at 2 consecutive quarters, negative quarters of GDP. That's what pretty much will get all the headlines for a recession. And this at least is a positive outlook for the rest of the year. The first quarter was a negative GDP number. And then as you go out towards 2023, lower growth numbers after inflation, but still positive. And if you just look at the consensus being the lowest number, it's at least positive at 2.1%. And in 2024, pretty much the same, 3% on Morningstar, the consensus being 2%. It's hard to really predict even out this far, but it is somewhat encouraging that it, certainly for this year, and even to a degree next year, a little more reliable numbers, that at least things are looking positive. But there's a lot that could happen that could change this. You've got COVID issues going on, the supply chain, a lot of the things we've been talking about. The war in Ukraine has had an impact on commodity prices. So there's a lot going into this that nobody knows how it's going to work out yet. But at least some encouraging signs from that standpoint. This shows the U.S. Treasury yield curve. And the way you want to look at this is that the red line shows you what it was in December 31, 2021. Then the blue line shows what it was at the end of April. So if you hear about a yield curve, what that means is that it shows you the maturity dates down at the bottom, and they go from left to right. They increase the higher number of years of maturities. And then the interest rate goes from bottom to top. So the yield curve traditionally will be the longer out on the yield curve you go, the higher the interest rate will be on that bond, in this case, the U.S. Treasury. So you can see at the 30-year, it does go down a little bit, excuse me, as far as that end of year measurement goes. But for the most part, you can see this is somewhat normal, whereas you move out on the maturity side, the interest rate goes up. So that's what a yield curve is. Then if you look at the most recent projection, you can see the numbers first off start at a higher point because we've had interest rates go up. And then you can see as you move out on this yield curve, you do have interest rates rising for the most part until you get out to that 20 to 30-year period where they are showing a slight decrease in interest rates at that point. So the main illustration here is that you are seeing the reflection of the rise in interest rates, that it gets a little bit steeper now compared to where it was at the end of last year. So this bar chart reflects what's called personal consumption expenditure, sometimes referred to as PCE, price index. So the Federal Reserve really likes to look at this. There's many CPI or inflation measurements. So again, this comes from Morningstar in the blue, consensus is red, the green is the Federal Reserve. So for 2022, you can see that the numbers are 4.5%, 5.5% consensus, 4.3% for the Federal Reserve. We're still at points where we're getting the inflation numbers around 7 to 8%, really not all-time highs, but highs over the last 40 years or so. However, because this is reflective of the entire year, it does show that there is the potential for inflation to start coming down later this year. In a lot of our readings, a lot of our research we're doing, it's pretty consistent that around the third quarter into the fourth quarter, inflation should be coming down. Not a huge amount, but coming down nonetheless. And then the projection for 2023, it actually drops back to almost where we were pre-COVID. So that's kind of interesting, and I've read this from a number of different sources. It's kind of hard to believe that would be the case. I've looked at inflation from some angles saying that it'll be higher than it's been because of the wage inflation that's taken place, which makes sense. And 3% has been a number that I've been reading about. This is even a little bit lower. Then as you move up to 2024, you can see the numbers drop off a little bit more, but pretty steady compared to 2022. And as I was mentioning before, this is going to change a lot. It's really hard getting out to this point and making predictions, even on this 2023 and the way things have been, even for the latter part of this year. But this has been a pretty consensus, if you will, type of prediction for this year from a number of different sources. So that could maybe decrease some of the volatility we're seeing, maybe slow down interest rate increases. And again, that'll help reduce volatility. And maybe that helps the markets a little bit because it usually will do better when volatility is trending downward. So the next couple of charts are just some of the ways you can reduce volatility in the portfolio and not necessarily have to bail out of equities entirely. And so the way you want to look at this, it's a little bit noisy, but it's comparing growth investing, large cap growth investing to large cap cyclical investing, or value investing is another way to look at that. So this is it's a comparison, a relative strength chart. So the way you want to read this, when the blue line is going up, that means large cap growth investing is doing better. And the black line is a 12-month moving average. But really just looking at some of the trends, when it starts to go downward, that means that the large cap value tends to do better. So you can kind of see just over this period, this goes back to like 2017, the growth had been rising. And now there's been a shift where value has started to do better. Now, yes, there was a little bit of a spike here last year in the second half of the year, but it kind of picked up and his value has been relatively performing better. So generally speaking, when interest rates are going up, growth will tend to struggle more and value tends to do better. So that's one way, by shifting some investments to value or large cap value very specifically, can cushion some of the market downturns we've been seeing. The S&P 500 is basically large cap growth, so that just gives you an idea. So if you're in large cap growth, kind of a lot of S&P 500 exposure, which has done really well for the most part over the last 4 to 5 years, except for the COVID downturn. But it's also gotten to be more expensive, and value is basically much cheaper at this point. The next slide is similar in nature in the way it's constructed. It compares mid-cap growth to mid-cap value. So again, when the blue line is going up, that's why it says growth is best. That means growth is performing better than value, in this case, mid-cap growth. But again, over the same kind of time frames as large cap value started to take more hold, the same thing happened on mid-cap value. And you can see all the way through current time, that trend for the most part has been going down, except for the second half of last year. And so when you look at if you look at a listing of value funds compared to growth funds, you will see that value funds are down this year. It's hard to escape the downturn that has occurred in equities. However, the high to low, or the year to date, is about maybe half of what growth is. So it's at least cushioned some of the downturn. And because value is so much cheaper than growth in general, the upside potential is there as well. The next one is small cap growth versus small cap value. Again, it's really the same illustration. You're seeing growth being the leader, heading up towards the end of 2020. Then value started taking over. About halfway through 21, it did reverse, but then it continued back up, meaning that value outpaced growth from that point until now. So very similar story as far as mid-cap and large cap growth versus value. And then this chart is reflective of just small cap to large cap investing, using a PE ratio, price to earnings ratio, or a way to value the market. And so this goes back to, looks like back into like the mid 80s or so. But the main thing to focus on is where are we today? And so the way you want to look at this, is that when you see like these points, the small cap PE discount, small cap PE less than large cap PE. Another way to look at that is that small cap is cheaper than large cap. So when you look at some of these points, that whenever you see this coming down or at really low points, then that means small cap is much cheaper than large cap. So the median is this red line across the way, just to give maybe some perspective or a relevant measure, and you can see how much cheaper it is. And so in April of this year, you can see the discount basically at 78 was about a 22% discount. So again, just broadly speaking, small cap is priced better at this point than large cap. Now, small cap can be volatile on its own because they're smaller companies. But when you're building out your portfolio, these are just a couple of ways that you don't necessarily have to get the cash because you're worried about the markets. But if you just reallocate your portfolio to the more cheaper areas, then that should, again, cushion some of the downside, not necessarily hurt you on the upside whenever the markets go through a rebound. Let's see. So what are some other things that we're doing? So some of the areas we made improvements in our client portfolios this year is we reduced the exposure to technology, just like probably most portfolios, excuse me, over the last 4 to 5 years. Technology has been just a big home run, especially with COVID, the work from home concept in 2020 that has continued. But technology, at least in our portfolios, was getting to be too big of a percentage because of the growth that incurred. So we reduced that exposure. We kept the exposure, but we took the profits off the table and allocated them to some of the cheaper parts of the market. One of those being large cap value. Again, there's the term value. We wanted to get more exposure to an area that was cheap, so we moved from expensive to cheap, or cheaper, I should say. We had some exposure in metals and mining and equities. That took off really well. Probably part of that was due to the war in Ukraine. So we took some profits from that. And sure enough, metals and mining has fallen off. It's had a really good year, though, overall. But we wanted to at least harvest some of those profits, maybe sooner than we normally would. About a year ago, we increased small cap value exposure. We added commodity exposure. That was towards the end of, I believe, last year. Commodities itself, in terms of tracking the price of commodities, has been one of the big winners this year. So we were pretty confident in this as we headed into the new year, and commodities started the year really well. And then the situation again in Ukraine pushed those prices up even further. As we headed into the new year, we carried some more cash than we normally would do. We made that as an active decision, given the volatility we were seeing. Nobody can time this stuff right, but since we had the cash already there, we didn't want to necessarily put the money to work as the markets were really falling off. So that's helped cushion some of the downturn as well. Again, not a long-term decision, but certainly helped in the short term. As I indicated with the bond market, we've been using floating rate funds or floating rate bonds for a good part of our bond allocation. That's made a huge difference compared to the treasury market. And we'll look at different ways we'll probably reduce that exposure over the next year as interest rates go up. More traditional bond investing becomes more attractive. And then we're doing research on some other asset classes that have low correlation to the market. One example is managed futures. It's an area we've used before that has done a terrific job in times of when volatility really picks up. You have the potential to get some positive returns in a down market. But one of the main things we like about that is that it really isn't correlated, meaning in terms of moving in the same direction as the market. You have some really low to even negative correlation numbers with different investments, at least in our portfolio, without hurting the potential return. So that's always a big win if you can find an investment that increases your expected return while decreasing the expected risk. So it's hard to find those things. Some asset classes have a track record of it, but they don't always work well at different points. With interest rates going up, it does open up some potential opportunities for those asset classes again to maybe help with returns and not necessarily drive up the risk level. All right, with that, I'm willing to take any questions and answers that anybody has. And I'll pause for a second just to see if any questions have come in at this point. Okay. So one of the questions has been related to the timing of different moves to make. And as I was showing you with that May 4th to May 5th graph of the S&P 500, it's really an impossible thing to predict. And I know that's always the traditional saying, you can't time the markets, you can't do anything like that. But at the same point, you really can't do it. But what you can do is try to shift parts of the portfolio for different parts of the market. And, just even at a more measured pace, like we're talking about our bond allocation shifting towards more traditional bonds as interest rates go up. We're not going to get the timing right whenever we're hitting more of a high point in the interest rate cycle, but you can see the risk trade-off gets to be better for adding in more traditional bonds, where basically over the last 10 years, that's been a pretty tough one to go at because rates have been so low. So it's really not about timing. It's about understanding how the portfolio you're using is built and how the funds react to each other, and then trying to make certainly some estimates on where you see interest rates going in this example, going forward. And as far as like parts of the equity markets go, I mean, my goodness, that May 4th to May 5th charts really are indicative of how difficult it is to time the market. So for us, we're looking at parts of the market, different sectors that maybe are just much cheaper than other areas of the markets, and maybe doing some shifting over to those areas, and just trying to make good fundamental decisions on where parts of the market can be that maybe will provide a little more growth and a little more cushion on the downside. Kind of similar to the 2000 to 2002 period where the technology bubble crashed. If you allocated the parts of the market that were much cheaper, small cap, value, in general, real estate, I think was pretty cheap at that time, you really got through that downturn in a very good fashion. But if you were strictly stuck in growth investments, technology specifically, it was a much different story. And then if you look at even 2008, which was just brutal for all equities, if you at least had some of the equities that were better priced, you still lost quite a bit, but it was nowhere near like the growth areas of the S&P 500 and how those performed. So it's a lot of constant monitoring that we do in terms of our client portfolios, breaking everything down by sector, really understanding where the exposure to, say, technology is, where the healthcare exposure is coming from, and then making decisions from there. It's a lot of testing. It's a lot of running different simulations in terms of how the allocation changes. But that's how you can really mitigate some of these risks. I'll wait to see if there's any other questions. Okay, I think that's it for now. So if you have any questions regarding your situation, your portfolio, want to get a feedback from that, you can feel free to reach out to that. We do a free second opinion for prospective clients where we're able to break down the portfolio for you so you understand better how you're allocated. And just feel free to reach out to us at any time. And now I'm going to turn it back over to Dan.
Okay, great. Thanks, Jim. A lot of great information you covered today, and I want to thank everybody for joining us for our latest webcast. If you would like to schedule a free conference call consultation with a member of our advisory team, please call our office at 412-635-9210 to set up an appointment. Thank you again for attending, and this concludes the event.